In energy projects, funding gets you started, but long-term contracts are what actually de-risk the business. So what happens when both fall into place? Today, we're looking at how a new helium offtake agreement could lock in cash flow and what that means as US Energy moves towards commercial operations. And I'm joined once again by Ryan Smith, President and CEO of US Energy Corp. Ryan, welcome back to the watch list.
Hey, Ricky. Good morning. Good to see you.
It's always a pleasure. So tell us, Ryan, you've just announced a 5-year helium offtake agreement with an investment-grade counterparty, which establishes long-term contracted cash flow for Big Sky. Can you walk us through the key highlights of that agreement and what it means for the business?
Yeah, absolutely. And again, thanks for having me. So this is a defining milestone for U.S. Energy and for our Big Sky Carbon Hub in Montana. The agreement is a 5-year helium sales contract with an investment-grade industrial gas company with global distribution infrastructure, one of the largest helium purchasers in the world. It's a take-or-pay structure on 100% of the helium produced at our Big Sky facility, with pricing fixed at $285 per MCF and annual CPI escalation beginning in 2028. And the point I would really emphasize is that the $285 is an all-in plant gate price. Our counterparty picks up the helium in our facility and handles all downstream transportation, tolling, and distribution. That's meaningfully different from how most helium pricing gets quoted in the industry, where $100 or sometimes significantly more per MCF of downstream costs often sit with the producer. The pricing we are reporting is what we keep.
And so with this offtake signed, Ryan, your expanded debt facility closed last week and first production targeted for Q1 2027. US Energy looks materially different than it did a few months ago. So what does this agreement unlock for the company going forward, and what should investors be watching for next?
Yeah, you're right. The company looks fundamentally different than it did even a few months ago. With the expanded debt facility that closed on April the 20th, and this offtake now signed, phase one at Big Sky is funded, and a meaningful portion of our long-term cash flow is contracted with an investment-grade counterparty. We moved from a development stage asset to a contracted industrial gas platform, and I think that's a real inflection point for how investors should think about U.S. Energy going forward. And what this unlocks for us is optionality. We've deliberately preserved future volumes for further commercial arrangements. The contract gives us a look at the market again at year 3 through a redetermination mechanism. And this relationship brings credibility that matters greatly as we advance planning for phase 2. In terms of what's next, there are really 3 concrete dated milestones investors should be watching. First is the EPA approval of our MRV submissions, which we're expecting this summer and which unlocks our carbon credit stream. Second, continued execution on phase 1 construction through the back half of 2026. And third, first commercial operations in the first quarter of 2027. We believe the combination of funded CapEx, contracted cash flow, 3 independent revenue streams, and a clear path to first production is a differentiated story, and we are focused every day on executing against it.
So we're marking a shift from development into a more de-risk, revenue-backed model, where execution and delivery will now be the key drivers of value. Thank you for your time today, Ryan.
Awesome. Thanks, Ricky. Appreciate it.
Once again, that is Ryan Smith, President and CEO of US Energy Corp. For more on the Big Sky Carbon Hub and the company's strategy, visit usnrg.com. That's all for this episode of The Watch List. I'm Ricky Lee. Make good choices today.